Moderate inflation is considered good for the equity markets because rising prices mean higher company revenues and bigger profits. On the other hand, high inflation puts pressure on your wallet and harms your investments. Rising inflation has triggered first interest rate hike by the RBI since August 2018.
The Monetary Policy Committee decided to hold an off-cycle meeting on 2nd and 4th May 2022 to reassess the evolving inflation growth dynamics and the impact of the developments after the MPC meeting of 6th to 8th April 2022. Based on this assessment of the macroeconomic situation and the outlook, the Monetary Policy Committee voted unanimously to increase the policy repo rate by 40 basis points, by 40 basis points to 4.40% with immediate effect.
This in turn will impact bond yields and prices in the secondary debt market. So what should be your approach towards the bond market now?
Now for debt portion, we have always been recommending debt funds. But in the current situation, debt funds are not looking all that great. Why? Because if interest rates are hiked, the bonds held by debt funds will become less valuable and the NAVs will go down. This is expected. So long-term bond funds mein to you should be out of long-term bond funds right now. Don't even think of entering long-term bond funds because they will be mauled when interest rates are high. If you want to be in debt funds which are more tax efficient than FDs, go for short-term debt funds because there the impact of hike in interest rates will not be so pronounced. If you're holding bonds of a maturity of 6 months or 8 months, even if rates are high, it will have a very minimal effect on your portfolio, on your corpus. But if you're holding a 15-year bond and there the rates are hiked, then it will have a very big effect on your NAV.
Is it a good idea to park your money in FDs?
And FDs, when we say FDs give you an assured income. So you can do a 6-month FD, you can do 8-month, a 9-month FD or a 1-year FD. So FD should not be seen as something which is very bad. Yes, it is very tax inefficient because the entire amount earned is added to your income and taxed at the rate applicable to you. In a debt fund, if you hold for 3 years, the rate is only 20% even, and you have to adjust against inflation also. Inflation is very high right now. So you might end up, actually booking a loss and being able to adjust that loss against any other gains if you invest in a debt fund. But at the same time, because of the rate hike, a debt fund may not be all that lucrative an investment. So at this point of time, an FD sounds very nice.
Can gold help in fighting this inflationary crisis?
Gold has traditionally been a hedge against inflation, but in recent years that correlation has broken down. It's no longer the safe haven in times of inflation, yes, but it still remains a safe haven against uncertainty. Like when the Ukraine war broke out, there was a spike in gold. Prices have now sort of flattened down because investors have got used to the idea of Ukraine. The hostilities between Ukraine and Russia have not flared up, but they are continuing. So there's, after a little while, investors get used to this kind of a situation and then they move forward. I'd only like to conclude that high inflation is here to stay for some time and you'll have to get used to it. High inflation will also mean higher interest rates. Maybe you will have the opportunity to lock in at higher rates for your FDs. So even when you're doing your FDs right now or your debt fund investments, stagger them. Don't take a 5-year FD at one go. Take a 1-year FD so that 1 year later when the interest rates are higher, that FD ends and you can reinvest that money at a higher rate.